Hi, this is Randy Finney with Right Side of the Chart, and this is a market wrap for the week ending Friday, September 7th, 2018. There were quite a bit of noticeable developments worth covering today or this week and into today in the market, so I figured I'd do a market wrap. Some of what I've already covered, some things that I haven't. And again, earlier today I mentioned in the trading room and on the video, I'd like to see how the day ended. And now that the week is over, let's take a look at what stands out and what we can expect moving forward. This chart I've covered many times in the past. I just want to hit on it real quickly. It's a weekly chart, 10-year weekly chart of QQQ. So just at the edge of the chart there, you can see back in March of 2000 when it's actually when the entire stock market but QQQ, remember QQQ is not really a diversified index. It's just a basket of 100 stocks. And even then, the top 10 make up almost the bulk of the return. So then NDX bottomed back in November of 2008, but that's a moot point. Just about every other sector and major index bottomed here in March '09. So there it is. There's your 10-year bull market, longest in history. Marked out and showed you this before. All the divergent highs, negative divergences, and the corrections have followed. 18%, 16, 13, 10, 26, 18, 12. This little baby divergent high back here. Let me show you that. And I wanted to update something that I noticed today in going through the charts. So there was your little small weekly divergent high. It was still good for a 12% drop. That second push up we had earlier in this year. But I also had earlier in previous versions of this chart mentioned or highlighted a small little divergent high here, right at this point when you look at prices from here to here, led to a 4% correction. But when I really zoomed in today, I noticed it didn't meet my criteria for divergence. If you followed me for a while, you know I like to see a couple things. I'm a little more picky than the textbooks on negative divergence and positive divergence. In other words, negative divergence is simply when prices on a security are making a higher high and the indicators are making equal or lower highs. In other words, they're not keeping up with it. And I like to take it a step further to filter out a lot of false signals, and I look for two successive peaks in the indicator, particularly in the RSI or the PPO. I'm sorry, RSI. I don't use a signal line, but in the PPO, I like two successive peaks for positive divergence, or two successive troughs, one higher than the other on bullish divergence. So there's your negative divergence. Now this point in time, we had a crossover here. There was your peak, but the line never crossed. We'd never had another higher peak there because we didn't have the PPO line cross back above the signal line and then turn down. So I just wanted to point that out. It's minor and probably doesn't mean anything today, but I've covered that in the past. So I'm going to delete those lines off the chart. I just wanted to make mention of that. And let's get that off there and we'll move on. Let's see there it is, delete. Okay, so and what I wanted to also, the reason I came to this chart, not just to bring that up, of course, take a look. We had a pretty ugly candle for the week. Nothing major. It's a red candle. It's the biggest red candle we've had in a while. And I'll tell you, in the weekly, it's pretty rare. At least we haven't seen a bearish engulfing. That would have been nice to see, but if you're looking for a short trade, that is. But again, we didn't have a bearish engulfing on either of these two tops back here earlier in the year. But what I wanted to point out is regarding those divergences I was just talking about, here was your last peak in the RS. We had a series of peaks actually. Peak right here, and here's your divergence line right here. Let me clear that out, draw the line. So this is that larger divergence I've been talking about. And again, we're zoomed in right here. Here's your uptrend line. Here's your divergence line. This is a pretty strong, powerful divergent high. And what I wanted to get to is you can see here today, the PPO is really turned down. Now, it hasn't made a bearish cross yet. That could come next week. It may not come. Sometimes these lines come together and they kiss and they bounce like right here. But currently, the momentum is quickly turning down, and we're poised for a bearish cross on the weekly, and that would be a pretty powerful. Again, I don't use divergences as standalone buy and sell signals, but it is, again, if we confirm those weekly divergence, the chances that we're going to go down, and most importantly here, this is a weekly chart. As you know, I've been migrating out from my focus on the intraday charts, the 60-minute charts. All of a sudden out to the daily, which we're going to get to in a second because now we have some early sell signals on the daily chart as of today. And then, of course, this weekly chart, because this would help formulate, okay, if we do get some downside traction in the market right now, are we looking to cover those shallow targets on the 60-minute chart? Or are we going to move out to the daily chart or possibly even the weekly chart? So I just want to say this right now, the bull run is very well intact and not in jeopardy of being taken out or called into question right now, because this is our trend line I'm watching on the weekly chart. It comes off the 2015 lows. And as you can see, QQQ is still, as much as we're down this week, somewhat comfortably above it, about a little over 5% right there. And just below that, you can't even make it out because there's such a perfect overlap. My favorite on the Qs and a lot of tech stocks and a lot of stocks in general is a 40-week moving average. I use the EMA, exponential moving average, and that's the red line right here. That's the same as a 200-day moving average on the daily chart. And you can see it just does a great job at defining uptrends on the QQQ. It does an even better job on Apple. Put that 40-week moving exponential moving week. Gosh, sorry guys, trying to talk fast. Put that 40-week exponential moving average on a weekly chart, or 200-day on the daily. But when you see the weekly, it's less whipsaws. The daily, it's a little more busy. And you'll see it just does a great job of defining trends. And sure, during the corrections, it'll chop on through there a little bit. But it does, and again, Apple, it's captured the bear markets throughout the bull market that we've had in the last 10 years. Apple, here, I'll give it to you real quick. Apple had its own little bear market right here, 45% drop. And you can see there, took out the 40-week moving average, which had just done a bang-up job of support. Every time it was tested, multiple times it held. So it said Apple's in a bull market, buy it on pullbacks. And when we broke it there, then we came back, tested from above, failed, 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 and then crossed back above it there. So it said, okay, safe to get back in the water. And again, did a great job of defining the uptrend until we broke it again there, and we had a 34% correction. So the two biggest and only, well, that's technically a bear market there, 26% drop, but it was quick. That was a little blip, 1-2 weeks. So you had a 45%, 34% uh, correction or bear market, you want to call it, in Apple. In both of those, you can see the stock spent some time under that 40-week moving average. So where was I going with that? Well, Apple's still comfortably above it, but you can see it also comes in well with its uptrend line. So there's what we're watching for Apple. QQQ, like I said, a little closer there, and it comes in together. And I really like that when I see that kind of setup in trading, whether it's a bullish or bearish setup. When I see intersecting support and resistance levels, and they don't have to be trend lines like this or price levels. They can be key exponential moving averages. Let me put an asterisk there. I only use moving averages, whether it's exponential, simple, if it does a good job. A lot of people I've seen will use 150-day, the common moving averages, and put it on any stock. But if I put a stock or a ETF or an index up, and I see that that index or stock has sliced through that moving average like it wasn't even there over the years, especially in recent months, it means nothing to me. So I make sure you get a good fit, like I like to say, where you can see the uptrends. When you get a pullback to that moving average, the stock usually reverses there. And then when you have a major inflection point, when the trend changes, you see a cross down below, and then that moving average acts as resistance. So I don't want to get too sidetracked here, but I do want to make mention that those are very important levels, in my opinion, to watch. That trend line and that moving average. We're still comfortably above it now, so nothing really to be worried about at this point. But keep in mind, stocks do fall a lot faster than they rise, so be prepared for anything if things were to get ugly in the next week or two. So moving on, QQQ. What happened today? Well, here's that key uptrend line I'm watching. Very well defined. We have a lot of reactions. Again, just focus on this yellow trend line right here that I'm highlighting. Goes back to early April. I've talked about this quite a bit recently. Several reactions there, reactions there, reactions. So we have a lot of reactions on this trend line. And in my book, the more reactions, the more valid that trend line is. More eyes are going to watch it, and the more significant it is when you get a break of that level. So what happened yesterday? Well, we broke it, but then we closed right about on it. I mean, you want to split hairs, we maybe close the hair below it, but it wasn't impulsive and it wasn't convincing. What happened today? Well, we followed through to the downside. And as I said, I wanted to see how things how the market traded today. We came back up. You can see there we back tested that trend line from below and then failed, and we closed comfortably above it. Not a big solid red candle. It will really help next week to seal the deal to see another red candle on Monday. And if so, and I think we will, I think we'll get more downside. I've gone over these targets. I have different targets on different time frames depending, if you're an active trader, you can look at the 60-minute chart, try to game bounces off those levels. But for swing trading, 178, give or take, is a net first target. Again, if we, unless we can recover that trend line quickly early next week. If not, we're probably headed down there. If and when that level breaks, I expect a little reaction there. Continue on down here. And this is my preferred swing target right now, 169.60, which also comes in with this orange uptrend line. That trend line goes to the left of this chart. It comes off those early 20 or mid 2015 lows. So there it is, a decent sell signal on QQQ. I still have a little bit of pause. XLK, the tech ETF, closed right on its bottom of its rising wedge slash uptrend line. This is a very comparable uptrend line to that one I showed you on QQQ. Yeah, there it is. I'm better on that one. So we need to see a little more downside in XLK to help firm that up. But you can look at the posture of the indicators down here. We have a bearish crossover on the PPO now that confirms right here. What that does is it confirms this recent divergent high, and in my opinion, greatly increases the odds. There's your crossover right there, confirming that most recent divergent high, and indicates we'll probably go ahead and break that down. And I don't see anything really slowing XLK down much until it gets down here about 69.18. And again, that's the tech ETF. Keep in mind, this will have a big rebalancing. I mentioned that the other day. At the end of the month, S&P will rebalance all their sector ETFs and everything within the S&P 500. So you might see some volatility, and we might have to be a little more liberal with the charts as they start to shuffle stocks around, because you're going to have a different basket of stocks going forward, representing the returns than we did up to that point. I think it's after the close on the 28th of this month, something like that. All right, moving on. Amazon. Amazon is, as you guys know, one of the largest components of the Qs. I'm focused right now on QQQ, and latest comer to the $1 trillion club. It held that. I mean, it didn't hold that value. It popped through there one day and fell back down, so it's close enough. But the point is, right now we're at trend line support. You can see a very well-defined uptrend line right here. Goes back to October of 2017. Lots of reactions along the way. And the better defined a trend line is, I think the more significant it is, and Amazon parked right on there. So there's a little more downside. If Amazon closes red on Monday, we're going to have a breakdown there. And again, it's usually what you're going to see, if Amazon breaks down, XLK breaks down, QQQ follows through to the downside, you're probably going to see the selling start to accelerate. So I don't expect these, another 0.32% down day. If we close red on Amazon on Monday, I'm willing to venture a guess that it's going to be 1% or more down. But hey, like I always say, support is support until and unless broken. So that's why we need just a little bit more. Otherwise, I would have gone home aggressively short over the weekend. As it is, a moderately short, and plenty of room to add on if we start to see some additional confirmation next week. So there it is. The only other thing I wanted to cover on the big QQQ components is Apple. Well, let's go back to a daily chart. On the daily chart, it's really not a lot that stands out other than it's, very overbought, coming off extreme overbought levels, and the RSI is now, or the PPO, I'm sorry, just made a high level bearish crossover, and you can see 3 red days in a row. Had divergent high written there. Now it's no longer a divergent high. Apple burned through those divergences. And of course, divergences are not by any means an absolute necessity for a correction or a top or anything else. But what does stand out is the 60-minute chart, which I've been highlighting recently in the trading room. We had this bearish rising wedge pattern, broke down. As mentioned, we had an impulsive move after the breakdown yesterday. We consolidated. We had a little bearish pennant type pattern going, They bought up the gap today and then faded that, so it kind of muddled that pattern up. So we don't really have much of anything other than the fact we do have a couple things. We had the breakdown, and that breakdown was validated with the impulsive selling, number one. Then we had a period of consolidation, but you can see we closed down below the bottom of that range. So we consolidated all day, and then the seller stepped in and dumped it towards a close and took us down below the bottom of that recent trading range. That to me is bearish. PPO tried to make a bullish cross right here, but was rejected. So the outlook for Apple doesn't look good. Again, anything's possible. If this market wants to rally up next week, XLK wants to hold that uptrend line, QQQ wants to regain it. Is it possible? Yes. But do I think it's going to happen now? No. A lot less than I did earlier today or yesterday. Again, favoring downside next week. And, these are all potential targets and areas I think you'll get a reaction. But I think Apple's probably good down here, especially if things really get going next week down to about that 206 level. Looks like a good place to cover a swing trade. But again, if you want to put a few wins under your belt and take some partial or even full profits at those earlier targets, it's hard for me to say now which one will be the last if we get down there, of course, because those are things you have to look at. What is the stock market doing at the time? QQQ, SPY. What do the intraday charts look like? The 5, 15 minutes. Those are all the factors that go in to my decision as to whether to cover here, here, here. If I were short this one, I'm short NQ, which gives me plenty of exposure to Apple. But if I were, those are the things I'd look at. And I know a couple of you in the trading room are, so if you want a second opinion on anything or an update, just drop me a line in the trading room and I'll be glad to do that for you. The only other thing I wanted to cover in this video, I wanted to touch on the semiconductors. I want to do that for a couple of reasons. Number one, semis are tech. They're widely considered the leading indicator, if you will, for the tech sector. So when the semiconductor sales start to slump, and of course you'll see it first in the charts. By the time you see things like the book-to-bill ratio turning down, and you're in the companies reporting, coming out with guidance, it's a negative guidance and earnings, that's rearview mirror stuff. I promise you that. You're going to see the stocks go down first, then the bad news will follow because that stuff is dated. Right now, insiders, those in the know, those in the industry, big money, they see what's coming before you're reading about it in the Wall Street Journal or Barron's or anything else. But with that being said, I do think that the semis have quite likely put in a top, and I plan to do a video. I don't want to do it in this video now. It'll take too long. There's 30 components in SOXX, and that's just one of three main ETFs in semis. There's SMH, XSD, and SOXX. Of course, those are the non-leveraged one-time. And SOXX I like to trade because this is the same, it tracks the same index, the Philex SOX Semiconductor Index, as does SOXS, the 3 times short semi ETF, and SOXL, the 3 time long or bullish one. Obviously, that's why the charts look the same. So there it is. So I use the one time because you get decay in those 3 time ETFs, and the charts can be distorted. I mean, this chart I know looks busy, guys, and it's probably a mess. I'll go over this chart a little more in detail in the other video, but what we have here is a series of divergent highs. You can see the indicator diverging, making lower lows, the RSI, the PPO, and that last high was a divergent high. And here we are. We're just a couple good days away from punching out the new all-time highs. So I made a comment in the trading room that I think these semis are quite likely in the very early stages of a bear market. I know that's a big, bold claim because we have absolutely zero evidence, being that they are trading near highs. But what I'm seeing is deterioration in the sector. It's fewer and fewer names that have been rocketing up, going parabolic. And where I'm seeing a lot of leaders, I'm seeing some signs like the chip makers. If the semis are the canary in the coal mine for tech, then the chip equipment makers are the canary in the coal mine for the chip sector. So companies like KLA 10 Core, which is KLAC is their ticker, down big in the last few days. See that selling? This is a daily chart coming right up on support here, put in a divergent high back here. And again, these companies like this one, they make the equipment that chip makers buy to make semiconductor chips. So usually when you start to see these guys roll over, that's not good for the whole sector. And back here there was a drop of trying to just measure it out. That was about a 46% drop. The tech stocks they're very cyclical, and the gains are big on the upside and downside. So it's certainly a sector to get on board. And right now, again, I think the next big moves to the downside. KLAC needs to take out this downtrend line, and then I think it comes down here to 89, roughly. I'm sorry, 80, about $84. And another big one is Applied Materials. Applied Materials is topped. I mean, that's the stock is already down 37%, not showing any signs of slowing down. I don't see anything in the charts that say that the move is over. Last time it peaked back here, it dropped about 42%. There was a big support shelf. This kind of looks like, if you recall recently, the NQ and ES E-mini charts that I was looking at. We broke trend, and then we had on those 60-minute charts a few days earlier this week, we had an area of consolidation. They were hugging above, and then they broke down. That's what happened here. And this breakdown just occurred. So this was our first sell signal right here, break below the trend line. Kickback rally to back test the trend line from below, put in another divergent high. We had a divergent high here, but we made a larger divergent high or an extension, and then boom, this one's moving lower. So where I'm going is here's the chip equipment makers. They already look to be on their way down. They already clearly have topped. I mean, you can't say this stock, I mean, maybe it stops here, but after a 35% drop, well, it certainly topped back then. Whether it's going to new highs or not, we'll all know, time will tell. I don't think so based on the charts. There's another trend line for Applied Materials. Don't want to get too far off topic. I could go through all of these charts, and I will in a separate video. And what that'll do is give you an idea on not only where the sector is likely headed, but also give you some individual trade ideas. You can either short the semis via an ETF. You have the diversity there. But if you want to sniff out the most bearish looking setups um, in the sector and avoid the most bullish looking stocks, I think you can outperform. So that's what I'll do the video. We'll get that out to you either possibly over the weekend, but maybe I'll wait till Monday morning to do that. We'll see what the market's doing at that time. And of course, as I said, the semis are under consideration, at least one of the ETFs, for an official trade idea, and I'm getting a lot closer, and that might even happen next week. Finally, before I wrap this video up, I wanted to point out while I'm on the semis, something that I'm seeing in that sector that convinces me that we might be in the early stages of a bull market. I'm sorry, the early stages of a bear market in the semis versus just a correction. And what that is I've noticed a pattern lately. Here it is. We're already on AMAT, so I'll start here. This is a daily chart. You can see I had this line here recently. I didn't post this on the site because I had my concerns about this stock or this pattern not playing out. You guys know I love to see on the daily chart for swing trading divergent lows, especially as a stock falls to support. There was a little bit of support right there. You can see these previous reaction highs back here. So there's a stock at support with bullish divergence and a nice downtrend line, almost had a wedge type pattern. But what happened? Look, the bottom just fell out. So we had, and this is more of a, this is not bull market action. This is bear market action or behavior when a bullish chart pattern fails to play out, just like in a strong bull market, bearish patterns have a much higher failure rate. So what we had here is a stock could have went there, could have rallied off support. The buyer should have stepped in. You had the divergence, and then boom. Now you can see the divergence is no longer in place. We had positive divergence the other day. Both on the PPO and RSI, those divergences have been negated or taken out by the indicators now making lower lows along with price. So there's a failed chart pattern. It's not a failed breakout. We never even broke out. We never even reversed off that level. But I also noticed that on Intel, and you guys probably know it. I've made clear in the trading room. I've had a little bit of pause in the semis lately because of this one. This used to be, or still is, considered one of the 800 or the 800-pound gorilla in the semiconductor sector, Intel. Intel, was clearly done here, and that was pointed out at the time. We had a divergent high. We were watching this trend line we broke, and that just couldn't have played out any better. This is technical analysis at its finest. After the wedge broke, you had a thrust down, first counter trend rally, and it continues to move lower. However, what was giving me pause recently, on adding the semis as an official short trade is this. You had a nice, clean, bullish falling wedge pattern. Looked like I said, textbook, confirmed with positive divergence. It broke out the other day, and as you can see, very lackluster buying, and so far that breakout has failed. Now, we can't write this one off yet. It's coming in, it's back testing that trend line or about to back test it from below at lower levels, and the divergence is still in place. So I have to point that out. I would be remiss not to. This may be, and let me tell you this, if you're bullish and think the market or the semis are going much higher, I think this is probably one of the best looking setups. There's a couple other semis that look pretty good to me. However, if this doesn't play out soon, then that is indicative of early bear market action where a beautiful looking bullish falling wedge pattern like this fails to play out and just deteriorates. So I just wanted to make mention there. Really speaks to the bigger picture, not just the semis, because if the semis are rolling over and have topped, tech is probably topped or will soon come down with it. I mean, semis are obviously a subsector of the technology sector, but looks like Intel is coming down here. I think if this pattern doesn't play out, next big support right here, that's a support zone about 41.64 to 43. I'm going to wrap it up here. Again, went through a lot of mm, things outside the markets, but the bigger picture, if you want to keep things simple, watch this next week. Watch this QQQ, see if that trend line is recovered right there, that trend line break that we had today. Watch XLK for a breakdown. It's on a comparable trend line that comes off the the early April lows. And watch Amazon, because if Amazon breaks and Apple continues to play out on that 60-minute chart, that those two alone will have a big impact on the market. So, like I like to say, support is support until unless broken. So we had XLK, Amazon closing right on support, with QQQ closing below it, but not comfortably below it, not a big red candle. So this whole movie will be continued next week. And if we start to see downside early on, impulsive selling, and we can't recover these trend lines and Amazon breaks and QQQ, things could get ugly pretty quick. So have your ducks in a row. If you want to buy the dip, buy the dip. This is where you buy it, or you buy it next week if these levels hold. But if anything changes, I'll update and post what I see. And as of now, like I said, looking for more downside next week. And if so, because of these are longer term sell signals, by the way, if this breaks, not just next week, this could be a sell signal that lasts for several weeks in the market. So we'll just have to take it as it comes. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it and have a great weekend.